So there's a view on what's happening in US small caps. Let's get some thoughts on the lay of the land here, particularly in the wake of reporting season. And for that, really pleased to welcome Simon Conn from Investors Mutual into the studio. Simon, good afternoon.
Thanks, Nadja.
We're in such a volatile environment.
Sure.
We're hearing a lot about inflation, rising petrol costs, pressures on margins.
Mm-hmm.
The reader that we got on small caps through reporting season, does it paint a healthy picture?
Yeah, actually it does. I mean, it's quite surprising, but the Australian economy is in quite robust health. And what we found, despite those cost imposts and also the disruption from COVID, where people didn't turn up to work or factories couldn't be filled by staff, most companies were able to recover a lot of those cost imposts with pricing. So we saw quite good top line growth, some compression on margin for some companies, but most other companies were able to pass those price costs on. So we saw quite a healthy top line and quite a robust reporting season.
Okay, so how about balance sheets?
Yeah, balance sheets generally pretty good health. I mean, remember over the last 2 years, a lot of companies had to raise money in concerns of what might come. I think that the worst case scenario hasn't played out, and so their balance sheets are in quite a healthy position. Obviously, some manufacturers and importers, they're carrying higher inventories because they're concerned about getting supplies. So we saw quite a few companies have weaker cash flows, carrying more inventory. But the commentary and the results sort of showed that they're putting up prices and able to pass on those cost imposts to the consumer or to their ultimate customer.
So when we hear from these companies next, whether it be a trading update or whether it be the next reporting season, is that inventory and free cash flow, cash burn, really critical to get an insight into how they're coping with the changing dynamics?
Look, I think there was a bit of a one-time step up in the inventory, so I think that cash flow impact was probably pronounced in the first half results. So I think looking forward, I think cash flow should normalise, and obviously because of what we heard through the half, there's a lot of concerns about being able to source more product. There was a lot of buffer stock being carried by companies, concerned that they wouldn't be able to source products out of Asia primarily. But supply chains now seem to be normalising, so I think we'll see some relief there on the cash flow lines.
So if supply chains normalise, is that going to be a net positive for, I know it's a big market to talk about, but for some of the small caps that you cover, or?
Yes, I think so.
So it'll be a positive?
I think so. Look, generally what the feedback is that Australian companies have outsourced a lot of stuff to Asia and been very reliant on just-in-time inventory management and very reliant on purely sourcing products from Asia. What we've seen with COVID and the breakdown of supply chains is that companies domestically are thinking more about having a domestic supplier as well as having an import solution. So companies like Pro-Pac packaging, which I've talked about on the show in the past, are now seeing lots of interest from your customers, particularly in the food sector, wanting to have them as an alternative supplier to import a product. And so I think it's putting Australian corporates in quite good shape. And I think that's why we saw the pricing power. Companies were able to say, for the first time to the supermarkets and to their other customers, we need price increases. We can justify them given what's happened with commodity prices and the increased costs of doing business. And they were able to get those price increases through. And we're seeing a reinvestment and a bit of a reinvigoration in domestic manufacturing. So companies like Pro-Pac, Pro-Biotech, these small domestic manufacturers that are able to provide some services to the domestic economy are really quite a good little niche and a good position.
Mm-hmm. Okay, so Pro-Pac is a company that you obviously like. What else was a real standout from reporting season in a company-specific manner? Yeah,
so the companies that we quite liked coming out of reporting season was another company was Pact in the packaging sector, and we like packaging because it is quite resilient. It's a pretty it's a pretty reliable type of business. So in a more uncertain world, companies like Pact and Pro-Pac we think look quite well, and obviously Amcor in the large caps. But Pact has been really investing in the circular economy for some time. So there's been a lot of talk about ESG and the movements to a more sustainable world. Pact, as the largest manufacturer of rigid plastics in the country, have positioned themselves as the go-to circular solution for companies such as Nestle or a Bega or a Mars, wherever the company may be, whether it's the dairy companies. Because they take more resin than anyone else, they're able to then recycle that resin and turn it into new product for new customers. And with their result, they announced a couple of new contracts, one in the milks, another in the beverage sector, where they're going to use recycled resin to manufacture new packaging for their customers.
That yearly chart, though, that's up on screen doesn't look too crash hot. So
no, look, it's been a disappointing performer over the last 12 months. Obviously, their contract manufacturing business, which was impacted by cost pressures, was a main drag. But I think investors have sort of sold the stock down heavily because of those concerns. But if you look at the stock today, it's trading on 10 times yields about 4%. Really good management team. And I think, it's sort of being misunderstood that the transition that's happening, their main business is actually doing reasonably well, obviously impacted by COVID. through the first half, but they were able to increase prices to recover that, as I talked about, and so their margins were fairly resilient. Despite the massive increase in costs and supply chain disruptions they saw, they were able to recover that, which I think is an amazing outcome in these circumstances, which puts them in a really good place for the second half of the year and going into FY23.
So if you don't own it, it actually represents value
Absolutely.
as well.
Really, it's really, at the moment, I think you're getting a very, an industry leader at a very cheap price.
Okay, great. Look, is there anything else that perhaps in another sector that really sort of caught your attention?
Obviously, it's a large company, but TPG Telecom is a company that is actually in the small cap sector of the market.
Yep.
Obviously, it was known as David Teo's telecommunications business, Total Peripheral Group. But following the merger with Vodafone, it's now become a full-service telco. And obviously, the stock's been impacted by a couple of factors. One was the COVID lockdowns and the inability for tourists to arrive in Australia and the lack of tourists from Australia going overseas, which has deprived them of a huge amount of roaming revenue. So they've been impacted by COVID. That's now clearly reflected in the share price. The merger of the two businesses was delayed by the ACCC, but it's now been consummated. And the merger presents the opportunity to take significant costs out of their business, to cross-sell to their customer base, whether it's in the fixed wireless or the mobile sector or the fixed line sector. And it's a really good management team led by Anarchy. So it's a really well-positioned business. And then it actually looks very cheap. It's trading at less than 8 times EBITDA. Telstra trades on over 9 times. Telstra was a good performer last year, but we think TPG's been left behind, in this rally. And we think it just looks really cheap and stands out on, in terms of real value. And
does it have much of an enterprise business as well?
Yes, so they've obviously got a big fibre business. So they inherited from TPG a very strong and modern network. They've got about $800 million of revenue in the corporate sector, and they've given an ambitious target of getting that to $1 billion over the next couple of years. They've recently signed Qantas and National Australia Bank as corporate customers, which really puts them in good light and as good reference customers. And we think their service levels and their cost of doing business, they're a very nimble and good quality service provider, which presents an alternative for those corporates looking for an alternative to Telstra.
It's really interesting because in the telco space, you often hear about ratings and how they're reviewed. That customer focus is so important in that sector.
Yeah, that's right. And I think TPG has always been a very nimble, an innovative company, and that's how TPG grew, as being low cost but good service, and obviously a modern infrastructure too. I think David Teo left the business with a very modern fibre network. So it's a natural cross-sell to me. Now they can offer a mobile solution to their corporate customers. With the recent deal they did with Telstra to share towers, their coverage goes from about 96% to about 98%. So they'll actually have higher coverage of the Australian continent than Optus, which really positions them well to be able to compete for some of those corporate customers. Obviously with the NBN, they can now reach the regional areas as well, so there's no disadvantage there. So the business it's got a good brand in Vodafone, well regarded, and a very low market share. So it's really under-penetrated for the level of infrastructure they have, which means they can offer really good services to the customers that switch to their network.